NIO stock is dropping sharply today, trading around $4.77 late in the session, down more than 5%, and once again sitting well below the $5 mark. What's unusual is that this move is happening on a day when the broader market is not collapsing. The S&P is stable, tech isn't being crushed, and the macro backdrop hasn't delivered a new shock. Yet NIO is sliding harder than most of the names around it. When a stock breaks away from the market like this, especially after days of weakness, investors want to know whether something has changed inside the company or whether external forces are driving the move. And based on everything visible right now, today's decline is being driven by external forces, not by new company-specific news. There has been no negative announcement from NIO today. No new regulatory development, no new lawsuit filing, no production issue, and no fresh warning about deliveries or margins. The company hasn't released anything that explains a 5% decline. That means the move we're seeing is the result of market psychology, technical breakdowns, sentiment toward Chinese stocks, and short-term trading dynamics. And those forces can be just as powerful as real news, especially for a stock like NIO, which tends to experience above-average volatility. The first major factor affecting today's drop is sentiment toward Chinese ADRs. Whenever global investors grow cautious about China, whether it's because of economic uncertainty, political tension, tariff speculation, or questions about transparency, Chinese stocks listed in the US often decline together. It's not selective. It's group behavior. And on days like today, when Chinese names are under pressure as a group, NIO almost never escapes the selling. Investors see the category, not the company. And that's what is happening here. The market isn't punishing NIO's fundamentals. It's punishing the perceived risk of China as an investment environment. The second factor is the technical breakdown below the $5 level. $5 is a major psychological and technical threshold. It's a round number. It's a place where traders expect support. It's where retail investors often place stop-loss orders. When a stock breaks under a level like that, especially after hovering around it for days, automated selling gets triggered. Algorithms detect the break, and they sell. Traders who don't want to hold a stock under $5 sell. Stop losses from retail traders go off. And before long, the momentum becomes self-reinforcing. The decline feeds on itself, even though nothing new has happened. Once $5 broke, today's drop became almost inevitable. Volume also plays a big part here. Today's trading volume is elevated compared to normal sessions. Whenever a stock breaks a key price level on high volume, that's a sign that the move is being driven by active trading flows, not just by passive market drift. This means that big players, quant funds, short-term traders, and algorithms are participating in the move. That makes the decline sharper, faster, and more directional. Even if the selling is not based on bad fundamentals, the mechanics of volume and momentum can intensify the drop. Another reason the stock is struggling today is the delivery narrative. Earlier in the quarter, NIO posted very strong October delivery numbers, hitting 40,000 units. That was a major achievement. But November deliveries came in lower, around 36,000. A drop of about 10% isn't catastrophic, but in the EV space, momentum matters. Investors watching for a steady acceleration may view the drop as a sign of inconsistency, even if it reflects normal production cycles. When sentiment is already fragile, even a minor slowdown can weigh on a stock. There's also the lingering effect of the lawsuit filed by the Singapore Sovereign Wealth Fund, GIC. Even though nothing new has emerged today, the presence of unresolved legal uncertainty contributes to investor caution. When a large, credible institution files a lawsuit alleging misleading financial reporting, even if those claims take years to resolve, retail investors and institutions hesitate. They wait for clarity. And while they wait, they reduce exposure. Again, nothing new happened today on that front. The lawsuit is simply a cloud hanging over the stock, and clouds tend to make storms feel worse. Another factor is the EV sector's complicated sentiment cycle. Demand questions, competition from Tesla and BYD, shifting subsidies in China, uneven global EV adoption, and concerns about profitability all create a challenging environment. Some EV stocks have rallied recently, but others remain under pressure. NIO has been stuck in a downtrend, and when a stock in a weak sector breaks through a big psychological level, the sell-off becomes more dramatic. Today reflects that pattern. It's not that NIO suddenly lost demand in a single day. It's that the EV landscape doesn't provide the kind of cushion a volatile stock needs when sentiment turns negative. Investor fatigue is another part of the story. NIO stock has been trending down for weeks. When a stock declines slowly and steadily over a long period, retail confidence erodes. Traders who once hoped for a bounce stop buying dips. Long-term holders start looking at other opportunities. And when those buyers step back, there's no one left to fight the selling pressure. Lack of buying is often just as important as active selling. In NIO's case today, the buyers simply aren't stepping in with strength. Despite all of this, the fundamentals of the company remain consistent with what we've been seeing for months. Record October deliveries, rising overseas shipments, increasing ES8 production capacity, and progress toward the launch of its Firefly brand in Europe are all real developments. Nothing about the company's operational story has changed on this Wednesday afternoon. What has changed is the market's emotional response to risk, the technical levels the stock is interacting with, and the intensity of short-term trading flows. This creates a specific narrative for an intriguing video angle. The best angle for tonight is to explore the idea that NIO's decline is not about the company's performance, it's about the category it belongs to. The stock is reacting to risk perception, technical breakdowns, and a fragile sentiment cycle in Chinese equities and EV stocks. It's the story of a company executing while its stock trades in an entirely different emotional environment. The hook for the video is this: the market is green, but NIO is not, and that disconnect tells you everything about sentiment. Viewers will want to understand why the stock is diverging. And the angle should highlight that today's drop is part of a bigger pattern. The stock is being priced based on fear and uncertainty, not based on deliveries, exports, or production data. The narrative should explain that this moment is significant because it reveals where the market sees risk. When stocks break psychological levels, investors overreact, algorithms dominate, and volatility increases. But none of that automatically reflects the long-term value of the company. The story is sentiment-driven, not fundamentals-driven. This also sets up a forward-looking angle. What matters next is whether the stock stabilizes around the mid-$4 range, whether Chinese ADR sentiment improves, whether EV stocks see renewed momentum, and whether NIO's next delivery report confirms the company's progress. These will determine whether today's decline becomes part of a deeper trend or a temporary sentiment flush. The takeaway for viewers is clear. Today's drop isn't telling you about NIO's factories, its production lines, its sales plan, or its global expansion. It's telling you about the market's risk perception. And as the session closes, investors will be watching closely to see if the stock finds support or continues to slide.